Hello, everyone. Welcome back. We're going to dive into this title. Admittedly, the title a little bit clickbait. The market always goes up. A little bit of an homage to J.L. Collins' chapter in his book. And yes, clickbaity, but you click through, you're here, excited to share the content. I think the content we're going to be talking about today is going to be very valuable. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan. I am doing quite well. Yeah, it's another nice, fun week here at our accidental homeschool world. And yeah, just kind of doing our thing. We had a nice CrossFit workout this morning, and Laura actually cut my hair this weekend, which I said, we talked about this about 10 days ago on the podcast. I thought it was going to be last weekend, but it happened this weekend, and it went rather well.
Yeah, I got to say, man, it looks good. Looks good. And you're growing a beard too, I see here. What is this, a quarantine beard?
Yeah. I mean, it's so funny. I've never grown a beard in my entire life. So I figured, why not experiment, right? I mean, now's the time. If it looks horrific, nobody's going to see me anyway, frankly. So yeah, it's kind of cool. And, I have to say with this whole haircut thing, we bought these clippers or whatever on Amazon for, I don't know, $35-$40. And I don't think I'm ever going to go out and get a haircut ever again. I think this is for life now.
I know. It's hard to go back once you've got something that works.
Which to any barbers or hairstylists in the audience, I apologize. But yeah, I mean, it's actually really convenient. It's a one-time cost. I'm going to save $20 every month, and I don't have to wait until I look scraggly and awful. Laura can just cut my hair every 2 weeks or so. So yeah, it's actually a net positive.
It's the time, dude. It's just the time commitment. That's the part that for me, I was like, all right, I'm all in on this. MK, how are you doing? How are things going in Florida?
We're doing good. It's still not oppressively humid yet. So we've been able to enjoy our walks, knowing that any day now, the heat's coming and we're just going to only walk indoors. So that's been good. And Jason and I are going to go pick up our groceries in an hour.
Ooh.
And I've been telling you guys, I'm over the moon excited just to leave the property because I have not left in a month. And so I'm just excited to sit in a car, drive to Walmart, let them put the groceries in the trunk, and then drive back. I am irrationally excited about this.
You could just have it delivered at your home, but you're so excited just to have an excuse to drive the car.
We get to go outside.
It is actually really nice. It's funny. I drove our cars just like around the block, essentially like a little mile loop first because, I have older cars, so I don't want these things dying in the driveway. So I actually put into Todoist, my little Todoist app, start cars every 5 days. So this is like a recurring task that I have.
How many tasks a day do you have on Todoist now? Just because I think of the sheer amount that you've added to this thing is your brain, right? Offloaded.
It is definitely my offloaded brain, but it's not that overwhelming. I mean, it's really only probably a handful, or at the most I'll see is 6 or 7 on a given day. So it's not too bad. But yeah, I mean, I really do try to offload every single thing I can think of into there. And MK, just wanted to talk. You're talking about taking walks outside. We're always looking. Jonathan has his silver lining segment of the podcast here. Our community this weekend had an art walk. And it was the coolest thing. We actually all, as many families as wanted to partake, set up little like tables or easels or whatnot at the end of their driveways. And we set up a big long table. We had, I guess the girls had a whole bunch of pieces of artwork that we like taped down. And, people just were walking by all day. We had our chairs set up a good 15 feet back and we were just kind of chilling. It was beautiful, beautiful weather. And, you get to talk to people that we had never met before. We'd never even seen before, frankly. And it was just really, really neat. So we saw that. And then obviously we walked around throughout the neighborhood. It was just a really fun time. So, again, we're kind of looking to highlight little silver linings and also things you can do in your own neighborhood. Like every single person out there could do something like that. You could send an email out to your community or whatever it may be and just start an artwork, or even just blaze a trail and do it yourself. And then maybe people say, oh, let's do that again next month. So, just think outside the box, and we can make this situation, which obviously is almost by any measure not ideal, we can make it with those silver linings. I think that's just a cool way to look at it.
Very cool. Well, let's talk about, I want to talk about predictions here for a few minutes, and just in the context of what we've seen over the last couple months and probably what we'll continue to see in the coming months and how that should affect our financial planning. So I want to add some context to the market always goes up. As I mentioned, J.L. Collins had a chapter in his book and also in his companion stock series on his website by the same title. And he's referencing this investment guy, and I forget the guy's name. I think it's like Dr. Lou or something like that. And he's basically countering the fact that, Dr. Lou tells you that whatever is happening in the market's going to go up, the market's going to go down. But J.L. Collins says it doesn't really matter. It's kind of just noise for the long-term buy and hold investor because over time the market goes up. Now, I'm sure that all of us have both kind of appreciated that the market always goes up for like the last 10 years, basically, since like the bottom in 2009 till 2020, we had this record 11-year bull run, and it quite literally always went straight up. But J.L. Collins wasn't saying that market crashes don't come. He was saying in spite of market crashes, in spite of all the horrible stuff that happens out there, if you have a long-term mindset, you can see a distinct trend, in which case, for the long-term buy and hold investor that has a plan that they have confidence in, they can ignore all the noise in between. And what do I mean by noise? There are a slew, even on a given day. Forget about pandemics, forget about wars, forget about oil embargoes. Just forget all about all this stuff. Even on normal days, you have people that are telling you, what's going to happen with the market on any given day. Add into that pretty traumatic current events like a pandemic spreading the globe, and the predictive nature of our human psyche gets turned on to overdrive. And with the power of the internet, the forecasts come at you really, really fast.
Yeah, there's no question about it. I mean, I think you have to be mindful that these prognosticators, they get paid to be sensational, right? Like that's part of the fun. It's a shtick ultimately, right? Like Jim Cramer, people aren't looking back, and this is not to pick on him by any means. People aren't looking back at what he predicted. They're looking at, is this guy entertaining? Ultimately, if you really think about it, like why is Jim Cramer such a famous name? Because the guy is just flat out entertaining. And I mean, that's not good enough when you're talking about like, should I base my investment decisions on what this one or whatever expert says? But it's just a simple fact the guy's entertaining. But yeah, I mean, Jonathan, I wanted to just quickly touch back on what you're saying about it's very important to say that J.L. Collins was not in any way saying the market just goes up and up and up. He very clearly highlights that on a given year, you're going to see a 10% drop at some point. In a given 5-year period, you're going to see probably a 30% drop at some point, or certainly in a given decade. And, he has all these stats of this is what's happened over the last 100 years. So unquestionably, there are massive drops. There are massive drops all the time. But when you look at a chart over a 100-year period, it certainly looks like it's always going up. And it's fascinating to think about that because, again, guys, our bias as members of the financial independence community is long-term. It's not short-termism. This is one of the most important fundamental bedrocks of financial independence thinking is we think over a 20 to 50-year period, not in terms of quarterly results or what the news is this week.
And, that is an intellectual exercise for the past 11 years. Like, oh, yeah, that makes sense. You've actually had your written exam, your oral exam has happened now, right? And so to kind of put this in perspective for people, on March 17th, we got the Imperial College of London, the COVID-19 response team. Actually, they shared with the United States this report that indicated that as many as 2.2 million people in the United States could die as a result of this pandemic. Now, the White House and everybody, I would say basically at that point, and around mid-March, all of us started taking this very, very seriously. You went from a level of nonchalance to we need to do whatever we can to make sure that doesn't become a reality. Goldman Sachs, around that same period of time, made their grimmest prediction yet. Now, I should point out for people just in terms of where we hit the bottom. We hit the bottom of currently, I think right now from where I sit, we hit the bottom of this thing on March 23rd when the S&P 500 went to 2237. I'm only mentioning the S&P instead of the Dow right now because Goldman Sachs in their report, which came out right around the same time this report, around March 16th, they were predicting to all of their clients, this was an internal messaging to their clients, but certainly, when it's this grim, it makes it to the rest of the world. They were basically saying this thing's going to bottom out around 2000 by mid-year. That's going to be a 41% plunge. And unsurprisingly, like that combined with a lot of the other news and a lot of other people that agreed with those assessments, we saw the market go down for sure. But strangely enough, right around March 23rd, between, I don't know, maybe a government stimulus, maybe it was companies that were rebalancing out of bonds into stocks, maybe it was just individuals feeling a little bit greedy and saying, hey, this is the bottom. They started buying in. And right now, the market, and again, I'm referencing the S&P 500 is sitting just above 2,700. Now, in between those two intervals of time, so right now being March or April 13th, and in between both of those, there were additional articles that came out March 29th. The next leg down is coming. This is an article on Seeking Alpha. And on this particular one, this individual was predicting, based on all of his historical analysis and based on the fact that he successfully predicted the initial drop, the secondary drop, and close to the bottom. He's saying, I actually think it's going to get far worse. I think the bottom of the S&P 500 is actually going to be down in between 1,400 to 1,800, somewhere in that range. That's going to be the real bottom. I say all that to say that on April 13, Goldman Sachs abandoned their bearish predictions. They say that we've already seen the bottom, and from here, we think it's going to go back up. I'm not telling you that any of them are right. Some of them have been right in the past. Some of them may be right in the future. The point is that none of them know. And they will all update their predictions to meet what is happening currently. They will abandon. They will give reasons that those didn't come through. They'll say, oh, it was the government stimulus. Oh, because of this. Oh, because of social distancing. Oh, because of whatever. We had to change our model and that. But the point is, all of that seems right with the benefit of hindsight. But you can't make your financial plan around these predictions. You just simply can't. You need to have a long-term mindset, and you need to be aware of your time horizon, right? When do you need this money? If you have a long time horizon, you've got to ignore the noise. You've got to. And Brad, that's just kind of like, I've always believed ignore the noise. I've always believed a long-term mindset. It was interesting to me to see how fast and furious the predictions of the end came, in March. And now how quickly some of them are abandoning it with I'm not going to say the word is accountability, but there were probably people that pulled every single dollar they had out very near the bottom. And what's their course of action now? They're going to wait for the market to go to 1,400 so they can buy back in for less? What a dangerous hypothesis.
Yeah, it is hard. Like you said at the outset of this episode, it's hard to plan your financial plan around the noise of the day. And I think that's really the biggest point that we want to get across here is that, clearly new information comes out all the time and intelligent people do change their minds. So we're not saying that by Goldman Sachs, like you said, they could be right. They could have been right. We're not talking about that particular instance, right? I mean, intelligent people change their mind when faced with new information. That's just the way the world works. But it's staggering to see this change on a dime. I think that to me is, man, you saw doom and gloom. Now, maybe irrationally, you're seeing this run up in the market. And I mean, what has fundamentally changed in those couple of days? Like, I don't necessarily know, but yet now everybody's saying we're through the bottom. I mean, that's wonderful if we are, but like, how does anybody really know? It seems like they're just kind of lagging by a day and saying, oh, the market's up, we're through this, right? Like, that's not a way to go through life successfully.
Yeah.
How you go through life successfully is you come up with a plan, like we've talked about ad nauseum here, right? And I mean that in a positive way, actually. It's like, we had your investor policy statement episode in the last week or two. And I think that's how you successfully put together a financial plan for the long term, right? You think about this plan, this investor policy statement in good times, not in stressful times, and you follow through with it, right? And you think in terms, again, of a 20 to 50 year period. And that makes a lot of the stress get reduced dramatically on the day-to-day, because let's be 100% clear, like, this is a stressful time. I mean, every aspect of this, of what we're going through now, is, to, I think, anyone alive, unprecedented, or certainly 99% of people alive. This is unprecedented. And we're dealing with stressors that we have not previously had to deal with. So this is difficult. But again, you don't make emotional decisions in the midst of the stock market going down or up, right? Like, Jonathan, that's a critical point. It's like, dealing with either irrational exuberance or this absolute pits of despair, like those aren't times, neither of them are times to make financial decisions and to change course 180 degrees. Again, the time is when waters are calm, like you said, you set your plan and you follow through with it.
Yeah, I mean that's it. And can you imagine if you are changing your thesis every 5 days based on what the latest report is? I mean, like every 5 days, you're trying to decide whether or not you're going to pull all your chips off the table. You're going to go try and get into gold or something else. And then you're like, oh, you know what? Actually, I've missed the bottom. Let me get all back into the market. Now, all of your money is tied up to whatever share price you can actually purchase it at. And you know what? Even if you knew exactly what the bottom was going to be, but you didn't know the when, you didn't know the exact time, you didn't know how to get in front of it, which for most of us as lay investors, even if you knew exactly what the bottom was going to be, it would be nearly impossible for you to nail the bottom. Like, it's just like, if you have this strong, let's say you have this strong feeling that tomorrow the market's going to go up. And so you want to get it at the best price possible. For the vast majority of us, we just simply can't. And so we shouldn't try. We shouldn't worry about it. I mean, I go back and I look at charts from, it's really helpful actually to go back and look at charts from 2008. Now, we don't know if the next 10 years are going to look like the last 10 years. It probably won't. But if you go back and you look at between 2008 and 2009, let's say you had $1 million invested at the peak of the market in 2008. Over the following year, you're 100% equities. Over the following year, the market drops by nearly 50%. And so your $1 million got cut in March of 2009, which is roughly the bottom. Your $1 million looks a lot like $500,000. All right. Right now, if you had not sold, if all of your money had stayed there, you would have doubled your money. I mean, and I mean this from the peak. Your $1 million would look like well more than $2 million. It would probably be approaching $3 million. And that's in the worst possible case scenario where all of your money got put in at the very high and you watched it crash by 50%, but you didn't freak out and sell because you saw an article on a website that told you the end was here, right? You're not going to even know how to find that article 10 years from now. Like right now, like I tried to, you know how hard it was for me to find the predictions from March 16th to see who was right and who was wrong? You know how impossible it is to find the predictions from 2008, 2009, even on the internet where everything lives forever? You simply can't. But you can track a trend line over 5, 10, 15, 20, 40 years and notice some patterns that are probably going to be beneficial to your long-term investing mindset and, frankly, as an extension, your wallet. And that is that over time, the market inexorably goes up.
Yeah. And Jonathan, like you said before, this is not us advising be 100% equities or just put your head down and don't think, right? Like obviously there are people who are closer to retirement, early or not, right? Like those people have to make their own financial plan. Like we are not giving financial advice at all. It's just, again, the long-term mindset. That is how we think. But clearly, there are people that are getting close to retirement. And in all likelihood, again, in their investor policy statement, not in terms of a reflexive emotional decision, but in their investor policy statement, they probably have started moving into bonds. And they probably also talk about rebalancing, which is actually an interesting thing during a run-up or, a large drop. So they should have that all set beforehand. And clearly, making moves based on your investor policy statement makes sense, right? But to do it in terms of an emotional decision does not make sense. So I really wanted to point that out that again, this is not us giving advice, but how we think about it is long-term. And Jonathan, I don't know about you, but like I have talked about this before, how my own brain, I know it gets in the way of my investing. And when you're talking about investing large lump sums or things like this, like I have a very difficult time with that, even though I know intellectually that's the best thing to do. At least all the studies that I've read suggest time in the market is more important than timing the market, right? So if you have a large lump sum, investing it mathematically makes the most sense. But for me, I like to put in like a dollar cost average. So putting in amounts of money each week or each month or every pay period, however you want to look at it, however it works for your life. But like for me, that psychologically is so much easier. And I'm just investing constantly. And again, this is in the way that I don't have an investor policy statement written down as we talked about, but that's how I approach investing for myself and my family. Is we put in on a regular basis money into our mutual funds and retirement accounts. And I don't have to then think about timing the market. It's just this happens automatically. And that for me, and maybe the limitations of my own brain, that is really very, very powerful.
You know, it's actually interesting what you just mentioned about lump sum versus dollar cost averaging. I had a buddy of mine reach out to me recently. He was in a situation where he was actually experiencing, or basically effectively a rollover of a pretty substantial sum of money, many, many tens of thousands of dollars. And it was happening right as the market was cratering. He didn't, unfortunately, I don't think he sold at the top. It ended up happening kind of somewhere in the middle there. So this individual, he was doing a rollover, and because it was from one institution to another, it could not be a transfer in kind, just as it happened. And so as this extended process was happening, unfortunately, the price that he sold it for is still lower than the price that it is now. So he's realized some form of a loss effectively with this. It's cost him a little bit of money. And so he would like, even though he has a long-term mindset, he would like to buy it at a price that's lower than he got out. And so it's an interesting time, right? It's like, well, is the market about to go down farther? Should I just be lucky should I just try to get in now? I mean, he's kind of riddled with this doubt. And there's two competing hypotheses. So the one end is that we have seen the bottom and the market's going to go straight up from here, in which case, obviously you're like, get that money in, get it in ASAP. The other is the S&P 500 is about to go down to 1,400. You don't want to have all of your chips, in the market now if you could get it for way less just a few months from now. And, this is for an individual to make. My personal mindset and position is I have no idea what's coming in the future. I know that I would do anything to buy it at the peak of the market in 2008 from where I stand right now. Just time in the market. Like even if you bought on the worst possible day in 2008, that is fantastic. But if you do that, if you lump sum invest that money, you need to be aware that there is a chance that it could go down. Like as Rick Ferry was just saying in this past episode, you could put all your money in and you could see the market go down by another 10, 15, 20%. Will that devastate you emotionally so much? You're so scarred from this that you're never able to invest anything again. And so kind of thinking through that out loud, my counterpoint was, look, if that happens, you're still young in your investing timeline. You're thinking with a 30, 40-year mindset. So just let's rationalize both sides of this. One, do you think that 30 or 40 years from now, your money's going to be worth more than it is today? You're the value of the companies that you hold are going to be worth more than they are today. And then two, if it goes straight up from here, aren't you excited that you got your money in now? And if it goes straight down from here, you are in as recession-proof a job as I can imagine. How incredible is it that you'll be able to dollar cost average your way with additional contributions as the market plummets and goes on sale? And neither of these rely on us knowing exactly what's going to happen tomorrow, or if something bad were to happen tomorrow, a new prediction were to come out, the economy were to go down farther, neither of these rely on us being able to successfully grab the bottom. And as you pointed out, Brad, a lot of this news is lagging by one day, and whatever decision you made, you've already missed the buyers that were truly capturing the bottom because of futures, et cetera. And so, I don't know. I'm not going to comment on what this individual actually did. I'm not trying to even influence someone else directly other than say, this is how I would think through it personally in my own plan. And this is why, when I have had similar choices in the past, I lump sum invested. And I will say that when I look at the times that I lump sum invested, and these aren't large dollar amounts like maxing out or HSA, et cetera, I was purchasing at far more than the market cost right now. And I don't regret that. I'm glad that I have my money in the market. To everyone out there, dollar cost averaging is entirely, and making contributions into this market is entirely contingent on you having your financial plan in place, you having your emergency fund in place. If you have not yet set up a high yield online savings account, consider CIT. It's one of the best high yield savings accounts on the market today, offering one of the best interest rates on the market today. For more information, go to choosefi.com/CIT. And if you're making contributions into the market because you're ready to start dollar cost averaging this thing, you believe time in is important, then consider M1. M1 Finance is my preferred robo-advisor of choice. I've been using it for years. And for more information, go to choosefi.com/M1. All right, guys, thanks for joining us. We'll see you next time as we continue to go down the road less traveled.